Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
That fuel for your existence, it's called money, and we talk about it here on Talking Real Money. I'm Don McDonald. Over there's Tom Cock. We have a really easy phone number for you to remember. It's 855-935-TALK, 855-935-8255. You can call that number 24 hours a day, 7 days a week, and most of the time you leave us your question electronically, and we'll answer it on the podcast because we now put up 5 podcasts a week. So there's a podcast all the time, and we answer questions on those daily podcasts, but also on this live show, which is every Saturday from noon to 2 Pacific time, 3 to 5 Eastern, 855-935-TALK. It's a lot about investing, but it's more about your life.
You said a lot there, partner. Woo!
There's a lot to say.
There is a lot to say. Again, I want to thank everybody who came out last week for Retire Meet, which was a great event. We already have the date for next year, which we can't announce because they won't let us reserve the space, I think, until like July or something.
I know.
I'm kind of weird about it. But anyway, so that will be
It's
next
all right.
year.
It was the best. I really was.
Here's the thing I love about
better at it.
Yeah, I appreciate everybody who comes out. People are basically every person I talked to there or since then said how much they enjoyed it. That it wasn't just a day long of seminars. It's fun. There's a lot of fun to the whole thing. So we've tried to add that in as we've gone on here. It's hard to believe we've done 5 of those already. Really,
I know.
Shocking.
I know. From and it just seems
time
like
to hand it on to the next generation, Don. But okay,
and
we'll
the
see what
fact
happens.
that this year's also Vestry's 10th anniversary.
I know.
We started this firm at my kitchen table 10 years ago.
Yeah, I remember the day because we had to be inside because outside it was like 105 degrees with 90% humidity.
Like it kind of is today.
Oh my gosh, was it hot? Had I known, I never would have gone to Florida in August.
It is so hot out here right now.
Yeah.
In Florida. People don't know. By the way, I'm in Florida.
Yes, he is.
I mean, what's the point in pretending I'm in Seattle?
We tell people that regularly.
I'm in Florida, and Tom's in Seattle, and thanks to technology, it's just like we are sitting here looking at each other, talking
very
just like
closely.
we were in the same room together. I love technology.
I know. It's remarkable.
I do.
In the old days, we never could have done this.
Never could have done this. 855-935-TALK is our phone number, 855-935-8255. Give us a call with your questions. Jason Zweig, our guy, our dude. We love Jason.
Mm-hmm.
Jason occasionally, sometimes Jason writes dumb stuff, but don't we all?
Indeed.
All of us as writers. But this week, it's like, hey, you regular investors, he calls them Main Street investors, you're not as dumb as Wall Street says you are.
Well, Wall Street always says you, as in you listening, are the amateurs. We're the professionals. We know better. We make more money. Ha! Not true. Not true. By the way, all you have to do is look at hedge fund performance to say, ha, not true, because those were the real professionals.
I'm just going to keep saying that.
I think you should. But, I mean,
true.
I love this article because he goes through and they talk to people about their money, and they found out that, basically people, they're smarter than you realize when it comes to all this. What stood out from you in terms of how smart people listening to this program are?
Well, I'm telling you, people, I believe that from Retire Meet, that's a great example, is that the vast majority of people at Retire Meet really did get this. I mean, they listened to Weston talk about the science behind the investing. They listened to you and I talk about it. But still, and I know that Jason's being very nice and giving a lot of people credit, but I also had a lot of people who came up to me who were just obnoxious in their stupid beliefs. Sorry, folks.
Well, give me
Your
one.
beliefs were stupid. Oh, look, I argued for a half an hour with a guy that indexed annuities were great.
That's right. I remember he started in with me, and I said, "Go see Don."
Go see
I'm
Don.
at my sandwich
He
now.
goes,
See you later.
Well, show me the proof. I said, okay, I can show you 100 articles.
well,
In fact,
wait a minute. You can show him a warning from FINRA about the product
know.
itself.
I know.
Really?
I said there's an investor advisory from FINRA,
Yeah, what
from
do
the
you
Financial
want?
Industry
Yeah.
Regulatory Authority, and Rick Gregorick's up on stage going, "Yeah,
That's true.
and it's
Yeah.
pretty strong language
Yeah.
that these are bad." But here's what happens: people go see a professional, and they are so convinced by this nice professional with whom they dealt that they suspend disbelief, they lose their skepticism, and they fall for these pitches hook, line, and sinker, when in fact, if they would just turn on one little thing, there's a little part of our brain, I call it the common sense portion.
How little is it?
For most people, it's pretty darn little.
It really
And
hurts.
Just turn that on, you would go, well, wait, you can't give me the returns of the stock market
With no risk.
with none of the risk. It can't be done. It should just be, that's not possible, move on. It isn't that way. We'll be back, 855-935-TALK.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
Got a question about money? Are you looking for a better way to invest? Are you sick and tired of being misled and lied to? I know you are. Give us a call at 855-935-TALK, 855-935-8255. We don't promise to have all the answers, but if we don't have an answer, we're going to find it for you, and we're not going to lie to you.
Short
Just not gonna tell you.
Venezuela. That's my investing recommendation.
Can you even go long Venezuela?
I don't believe so.
I don't
By the
think
way,
you
the
can even
market,
own
the best
Venezuela.
performing market last year is a market that I don't think you should invest in either, which was
I don't know.
Jamaica. Only trades for a
Did
couple hours a
Jamaica
day.
any money?
Hey, I like that. It's a good one. Yeah,
Thanks.
okay.
Yeah.
Good work.
8-5. But before we get any deeper
Yeah.
into this, let's
Yeah.
go to the phones.
Okay,
Pete,
save
welcome
us.
to Talking Real Money.
Hi, Pete.
Hi. Say, I've got a question for you guys on a portfolio. What percent do you think should remain in cash? What's your thinking on the percentage of a portfolio in retirement that you would maintain?
Are you
cash?
drawing? Are you drawing on the portfolio for living expenses?
Partially, a small amount.
I would keep that amount for 6 months in cash. Everything else would either be in stocks or bonds.
Okay, so you're
I would
thinking
concur.
6 months.
Yeah, because generally, and by the way, I think I mentioned this last week, it's about $8.5 trillion that are in cash in banks, and the banks love you. Thank you. Because they take that money and they put it in something that makes them money. It's the most inefficient thing people do with their money. And generally, when people have money in cash, the reason they have it in cash is they're waiting for something to happen. I'm waiting for Boeing stock to go down to 300 so that I can buy it, generally. That's why. So cash, and you see these asset managers say, this month I have 49% in stocks and 30% in bonds, and the rest is in cash because they think something's going to happen.
waiting
in the market,
for an opportunity.
whatever the opportunity is. So no, cash should not be part of a portfolio as an investment. It could be there to pay the expenses. Every 6 months seems reasonable. Then at the end of the 6 months, you rebalance the portfolio. Things that went up, Murray, you take that out, you pay yourself. That's how I'd look at it.
It could
What?
even be a year.
Yeah, 6 months to a year.
Yep, I think that's a fair amount.
All right. Thanks, guys. Appreciate
You're most
it.
welcome. Yeah, I mean,
You're very welcome. Thanks
most
for the
people
call.
are horribly inefficient with their money.
Well, but it's again, it goes back to this flaw in our nature. We all believe, and this was some of the stuff that was in Jason Zweig's article we talked about earlier. We believe that we know. He was talking about some of the experts and how they don't actually analyze the information. They use their incredible knowledge to make an educated guess.
Well,
the most important word in there is guess.
Well, the thing that we really most believe is my favorite quote from the article. Most people won't be able to do better than average. But I'm not most people.
Right.
I mean, come on. When it comes to driving, to all those other things, we're all above average, right?
We're all not
I'm
most
sorry.
people.
I'm sorry
right?
to say.
You are.
Yeah.
You know you are. You are special.
I love that quote.
But
I love that quote, but sorry. You're not.
so
yeah,
frustrating.
anyway. We're not most people.
935 Talk is the number. Diane, you're next. Welcome to Talking Real Money.
You're not most people, are you, Diane?
No, Diane is special.
She's special.
Are you special?
No, she's not even going to answer us. Okay. Well,
Not gonna tell us.
Right. I'm thinking, yeah, right.
Well, you called this show, so you're not most people. How can we help you?
I've got a question. When I was looking up CDs and also different savings accounts, I see that some say that you the percentage that you get is based on a daily amount and some on a yearly amount.
Are they talking about their compounding periods?
Yes.
Yeah. When they compound can make a difference.
Yeah.
A lower rate compounded daily is better than a slightly higher rate compounded yearly.
But how much higher is it? Because one of the banks...
There should be an effective annual rate,
That's
or you
the
can
number.
ask for the effective annual rate.
And effective annual rate. That should tell you what you'll make in a year's period of time with that money in that particular security.
Okay.
Because you're right, you can't compare apples to apples if you're doing it the other way, right? Because it'd be hard to figure out, well, if you're compounding that daily, looks a lot different than compounding that monthly. You're absolutely correct.
Exactly. But some of the banks, and there's not very many of them, that offer a daily basis.
Yeah, give me the interest rate. I can just run a quick number for you, and I can tell you the difference. What kind of,
I don't remember it. It was
Here,
the
I'll
banks
just
that
throw
I was
in- let me just
considering
throw
were
in-
Synchrony or Capital One.
Which
Yeah,
both
let's
have
just-
fairly high. I think I see them on bank rate from time to time for having high rates in terms of those type of investments, whether it's savings accounts or CDs.
Right.
Yeah, let's just look at a 1 year period, and we'll do a yearly at 2% per year. That's
Okay.
going to be a 2% return.
Should be.
Right.
Yeah.
Okay. If you do it daily, though, that same 2%, you compound that daily, it's a 2.2% return. 2.02. I'm
Yeah,
sorry.
2.02.
2.02. Makes sense?
Okay.
It's kind
I
of a
see.
So it's
rounding error.
fractionally
Yeah,
higher.
It's really not much.
But if you carry it out for a longer term, let's say you go with a 5-year CD, calculated 2% calculated daily, the difference is an extra $50.
And if you did that with like
Over
$10
the
million,
5 years.
it'd be a lot big deal.
On $10,000. Yeah, it's not a lot of money difference, but it is a difference whether they compound daily or annually.
Okay.
Okay.
Okay. Thank you.
You're very welcome. Thanks for the call. 855-935-TALK
That is
is the
confusing.
number. Yeah, it is. And it's really not a lot of extra money.
No.
It was back in the days when CDs paid 10%.
Yeah.
Daily compounding really made a difference.
You could
But
see
with-
why
with
Gerald Ford wanted to whip inflation
Whip
now.
inflation.
Then, yeah, right. Bingo.
You're going back to
I'm
that
sorry.
again,
It was
aren't
too
you?
easy. Yeah.
I mean, if we did 10% on a 5-year CD and we calculated it yearly on a $10,000 CD, you made $6,000.
And what is the high right now bank rate for a 5-year?
Oh, 3.
Is it 3? Okay.
I'll go. Let me go look. And
It's
but if
still
you did
low.
it daily, instead of 6,000, you would have made 6,500.
Okay. Well, $500
Let's go
here, $500 there.
Pretty
Adds
soon
up.
you're talking real money.
Indeed, you are. 855-935-8255.
I'm going to look it up
Yeah,
really
give
fast.
us the number. Give us the
CD rates.
3 years.
Don't go away,
5 years,
show.
pardon me. 5 years.
5 years. 5 years. I'm not going to be able to do it fast enough because my computer's running slowly. So I'm going to do it after the break.
Okay.
855-935-TALK is our phone number, 855-935-8255. Oh, it's 3.1%.
Tom and Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information, talkingrealmoney.com.
your guides to a really great financial future. Tom and Don are talking real money.
You make a call, you get help with your money, and you get a book on investing at 855-935-TALK.
And before we go to Chad, I have to question, seriously, why would you buy a 5-year CD?
Only as part of a ladder.
Okay, I was saying that.
Only
Okay,
as
I can
part of
see
a ladder.
that. Which, tell us what a ladder is.
A ladder is when you buy, you take the money that you're putting into the fixed income investments,
Yep.
whether it's bonds or CDs, and you can ladder it out so you have money maturing in a year, 2, 3, 4, 5.
That you're
and then
paying
when that
for something.
Then that first year, when it comes due, you roll it immediately into the longest maturity back into a new 5-year.
So it's like your bond portfolio then, in a way.
It's like your bond portfolio,
all right.
yes.
But if you buy a
the
bond mutual fund, it does that for you.
It does that for you, but with a CD, there's a level with a CD ladder. There's a level of comfort.
Yeah, that's true.
In that
It's insured.
there is no volatility.
That's true.
Of principal.
Because you could own the Vanguard short-term investment grade bond fund right now, which is paying 2.7, but there's a risk that I think it lost a little money last year, if I remember
It
right.
did.
So,
It lost a little bit where the CD ladder would never lose, but
Fair
you
enough.
might end up making a little more with the bond portfolio over time. It's not that big a deal either way. It's just the bond mutual fund is easier to
Money
do
goes in there,
than
they
the
take
ladder.
care of all that for you.
The ladder, it requires a little bit of work on your part. That's it's something people don't like, so they get lazy or they play the stupid guessing game. Oh, well, wait, that money. I think everybody says interest rates are going up. I'm just going to wait a little while. Yeah, we've been waiting for 10 years for interest rates to
You made that
go
good
up.
point on the podcast recently that rates really haven't changed very much.
They really
Very
haven't.
small.
855-935-TALK's the number. Chad, you're next. Welcome to Talking Real Money.
Hi, Chad.
Hey, guys. Thanks for taking the call.
Our pleasure. How can we help you?
Hey, I've got 2 questions for you. One being, so I just sort of heard your facetious remark about us putting our money in the banks and letting the banks sort of invest as they want, and we're just sort of sitting here as little lemmings, letting them invest our money.
Tom is a smart aleck that way.
No,
He really
I'm
is.
serious about that.
Oh, no, I love it. No, I love it. That's speaking my language, and it really instigated me to give you a call and say, what do you recommend? I mean, if we've got just to have cash money on hand, 1 to 10 grand sitting in the bank, and we want to make a couple bucks on it without getting it tied up for 3 to 5 years, and we want to be able to draw on it at any given time, what do you recommend? And then
That's where you shop. That's where you shop for the money market rate, Chad. That's where you go online to Bankrate and you find a 2% money market instead of the 0.2% at your bank.
And this is an argument Don and I have regularly. We just mentioned the mutual fund that I believe in and have used for short-term money, which is the Vanguard short-term investment grade bond fund. It's yielding, as we pointed out, about 2.7 right now. There's a modicum of risk because those companies may not be able to meet their obligations.
Sure.
But you're made a little more for that
And
risk. What's your other question? Go ahead.
So the other question being, what's the percentage that you guys recommend, or personally maybe even divulging into cryptocurrencies of your portfolio?
Oh, that was
have
easy.
that one. Let me have that one. I love this question. How much air should you have in your portfolio?
How much air?
Yes.
Air, just air. Air, nitrogen, oxygen.
The mix.
How much should you have in your portfolio?
I don't know, enough to breathe, I guess. Keep it alive.
That's pretty much it. Yeah, and you don't really have to pay anything for that. Cryptocurrency is stupid. It's absolutely one of the dumbest things ever created. It is far more. It's miles more volatile than the stock market, and yet it does nothing for the economy. It cannot become more valuable in and of itself. It's only when another idiot buys it at a higher price. So it's the greater fool theory of gambling. It's not even investing. You can't even use the term. Crypto is the dumbest thing ever.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at TalkingRealMoney.com.
Reality radio for a really great future. We're talking real money.
You have a standing invitation to call us anytime, actually, 24 hours a day, 7 days a week at 855-935-TALK, 855-935-8255. I'm Don McDonald. That's Tom Cock. This is Talking Real Money. Thanks for joining us, and let's try to help Mark here. Mark, welcome to Talking Real Money.
Hey, Mark.
Hello. How are you?
We're doing great. How can we help you, sir?
So, I just had a question for you on bond funds versus investing directly in bonds. Some time ago, I was speaking to an advisor at one of the houses. I have an account at Fidelity, and that person was encouraging me to invest directly in bonds and mentioned to me that one differentiating factor was that bond funds, in some cases, they don't hold those bonds to maturity. And that would be a disadvantage versus, buying bonds directly and holding them to maturity. I'm curious if you have any comments on that.
Yeah, it's baloney in the case of index funds, which is the only kind of fund we suggest. In an actively managed fund, sure, they're going to be trading in and out, and we'd never suggest an actively managed fund in a billion years.
Yeah, I mean, here's the other thing to remember about buying individual bonds that you really don't see, and the person selling you the bonds doesn't point out.
And doesn't want to point out.
There is a cost to that is far greater than hiring a company like Vanguard that's going to own thousands of bonds, which reduces risk, right? Because you get different maturities, different et cetera, et cetera. Professional management, and the fact that if you own individual bonds, they could go default. If it goes default in a bond portfolio of a lot of them, it doesn't really matter. And the cost. This is the part that drives me nuts.
It's the spread.
They forget to tell you that. Yes. So you're paying a price for that you don't see. And I think the last time I read about this, Don, somebody pointed out that it's probably 3 or 4%. It's like a typical commission.
It depends on the kind of bond. Yeah. Government bonds have tiny spreads, so if you're just buying government bonds, that's okay. Corporate bonds can have ridiculous spreads. Municipal bonds, some have reasonable spreads, and some are outrageous spreads, depending on the liquidity of the muni bonds.
The only case where I think this makes sense is if you're talking about tens of millions of dollars.
Yes, there you go. Exactly.
Then you're going to own individual bonds. There's a lot of reasons why, But for the rest of us mere mortals, myself included, because I drove here in my Honda Pilot today, it's just going to be a bond fund. I'm sorry. It's not as much fun either, by the way, but it's been better. I'll put it that way. All right?
Because this individual did indicate to me that there would be no cost to me.
Yeah.
Right, there is no commission.
Cost, because you can't, it's a spread.
Right, there is no commission. It's the spread. What they do is they buy a bond from someone selling a bond at, let's say, $900, and then they sell it to you at $940.
You don't see that.
They keep the difference. They keep that $40, but they don't have to report that to you as a cost. They're far more lucrative for Fidelity or Morgan Stanley or Merrill Lynch. I mean, we were told when I was a broker, we were told to sell individual bonds to people because it was a great way of not having to show them a commission.
Yeah,
it's very
slippery.
It's very opaque.
So
it's an opaque business.
Mark, thank you for your call. Go ahead, Don.
935-TALK, 855-935-8255. Christian, you're next. Welcome to the show. Hey, Christian.
Oh, we lost Christian. That didn't sound good at the end there either.
That was not a good sound.
Christian, did we lose you?
It's kind of like they dropped Christian down a well. It was like you hear it go.
You can call back the aforementioned number.
That's the only problem with technology is that, wow, when you were calling people on a copper wire, it just always worked.
It seemed to, yes.
It did. It just did.
I can remember getting disconnected with phone calls with copper wire.
Only long-distance calls.
I'm talking about where people drop the phone from the other end.
Oh,
I remember that. Yeah. Anyway, so
but these things,
it's a different matter.
Electronic
it's a whole deal. Getting up on the tower, et cetera, et cetera.
There's a lot of connections. Well, and you got to figure it's jumping about 3,000 times across the country.
Bingo.
Through different switches before it gets you. So it's actually pretty amazing it works. I'm just getting rid of my copper line, by the way. Just now getting rid of it. 855-935-TALK's the number. Get us going.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
We still have plenty of time left in the live show, and then you've got time to call us, well, all of the rest of the time. You know, if you're listening to this on a podcast and you're going, oh, I missed the live show, I can't call. Yes, you can. Just call 855-935-TALK anytime and leave your question there. We've gotten a lot of great questions left over the system.
Get live feedback like you provided for that gentleman about cryptocurrency. The love you show the people, the affection,
the love,
all that stuff. Yeah. No, you don't get that.
So. Right. Yeah, I'm always so loving.
Ouch.
Let's go to the phones again, shall we?
Why not?
Christian, you're up next. Welcome to Talking Real Money.
I'm just glad you're okay because somebody said you sound like they dropped you in a well or something. So.
Oh, yes. So I'm glad it wasn't something I said.
Indeed. How can we help you, sir?
You were speaking to a gentleman earlier about how much cash should I keep in retirement, should I keep handy, and you mentioned like 6 months to a year. And I've heard kind of an alternative theory that on the surface sounds very logical. I wanted to see what you thought about it. She said that in retirement, you should keep about 2 to 3 years worth of spending money cash because most bear markets drop and then recover over the space of about 2 years. And this is a way to just completely insulate yourself from that bear market and not be forced to draw money out of a down market that you can never recover again.
You see, that's
so. What do you thought about
think
that?
The different. We're talking about. I think we're quibbling over semantics because we're talking about cash, immediate cash, not bonds, but cash with today liquidity. You don't have to sell anything. You just get the money. Everybody who invests should have a portion of their portfolio in fixed income investments, whether that be a CD ladder or a high-quality
wait a minute. My 11-year-old
fund.
daughter doesn't need anything in bonds.
Okay, everybody who has any kind of fear of the market.
Good point. She doesn't know anything. No, because what we're talking about here is so if you're retired, it's likely that a bunch of your portfolio would be in bonds. Those bonds in bond mutual funds
they don't move
around a whole lot. Yeah, there's some, a little bit here or there at the edges. So you could draw on that before drawing on the stocks, Christian, that would supply those 2 or 3 years in a bear market. Does that make sense?
So that wouldn't cause you to be out of balance then in your portfolio because you've drawn exclusively out of your bond funds?
Well, actually, what you would be doing, this is exactly what you would be doing. This is why rebalancing is so effective. Because let's say it's the stock market is down. You got half your money in stocks, half your money in bonds.
2008.
Doesn't matter.
Yep.
Yeah, the stock market goes down 50% you're down 50% at the end of the year. What you are going to do is you're going to rebalance by taking money out of those assets that are now worth more as a percentage of your portfolio. So you'll take some to spend, and then you'll take the rest and go buy stocks while they're down.
Taking from the rich and giving to the poor. So the rebalancing works exactly right there, as Don points out. Not only are you replenishing the cash from the thing that has done better, you are buying stocks which have gone down, so to get back to your correct mix of stocks and bonds.
Okay, so you'd have to have enough in your bond funds to feed both your cash and your stocks.
But if you're 50-50 stocks and bonds, you're going to have a whole lot of money in your bond portfolio.
Mm-hmm. Yeah. Okay.
And if let's say if you're 50-50 stocks and bonds and you don't have enough to last through 2 years of a bear market or 3 years, then you don't have enough money. I mean, you really die. I mean,
shouldn't be invested.
That's what it comes down to.
Shouldn't be invested.
Yeah. It shouldn't be invested at all. It probably just needs to be in cash to keep you alive.
Yeah.
But if you have an investment portfolio, then you do what your risk tolerance and risk need calls for with the portfolio, and that keeps you from panicking in a bear market. You don't keep it in cash; you keep it in fixed income.
By the way, I need to give you some credit, Don, because I don't think you heard this. I don't think we shared this with you. That a week ago, We had the folks in from Dimensional Funds, a mutual fund family we believe in that manages all of the stock mutual funds for our clients. You have always said dollar cost averaging is not a good strategy because it's kind of similar to what Christian was talking about. Because at the end of the day, dollar cost averaging is I'm putting a little bit in now, I'm putting a little bit in later because I'm nervous the market's at a high, et cetera, et cetera, et cetera.
Right.
If you look at the market day to day, this is according to their data, it's about 54% of the days are up, 46% are down. But then when you get into the months, it's almost 70% of the months that are up months for stocks and 30% are down. So their take is, you invest for whatever your risk portfolio, your need for return, and your time horizon from day one. There is no reason to dollar cost average into a market.
There actually is. But that's only, and this is what, when you earn money, you should dollar cost average that. You should put it in immediately upon earning it.
Yeah.
That's you, because you dollar cost it, basically when you earn money, you're dollar cost averaging your annual income.
That's true.
So
you're getting it.
Invest it
right,
then.
Yeah.
But I've always hated dollar cost averaging. When somebody says, "I got $100,000 and I want to eventually get it in the stock market, should I just go ahead and dollar cost average?"
Because the market's at an all-time high. That's the
But it's always gonna. Its next high is gonna be its all-time high.
I know.
That's the way it works. And the number's even bigger when you look. So monthly it's 70-30. Annually it's 75-25.
Yeah, exactly. By the way, I want to mention,
markets are up more than they're down.
Before we run out of time here, that Barbara Devereaux, our wonderful managing advisor, is beyond just her terrific management skills, which is good for you and I.
You found she's a good speaker.
She's a phenomenal speaker. She got so many great comments from Retire Meet. She's doing Female Financial Fundamentals on the 20th of March. It's already sold a bunch of tickets. That will sell out in like the next 10 days. So if you're a disbeliever, you didn't think we'd sell out Retire Meet, 2.5 weeks early, sold. So if you want that, go to talkingrealmoney.com to sign up.
Her class at Retire Meet.
Packed.
They ran out of seats.
Yeah, it was packed. And people loved it. I walked in right at the end, and they said, "Get out of here." Barb's, okay, all right, I'm stepping out.
Get out of here because you're a guy.
I think it was a little bit of that. So she did a phenomenal job.
And that's the other thing. That was the other thing that, I kind of peeked in from outside, and there was a female camaraderie.
Yeah, definitely.
I think the class was very comfortable for the women who were there because it was taught by someone who's been through all the things they've been through.
Indeed.
She's been a wife and a mother and a grandmother and worked, been a working mom and struggled with those competing needs. And so she really does have empathy and
she took care of her mom. She has all those stories.
And she took care of her mom. So she had that other care story. So she can really relate to all of the women in the class. And the nice thing about this is it's one of our lunch ed classes, which are great. It's just an hour-long class. And you get a nice lunch from Panera, a salad and a sandwich. The reason we charge $10 is because that covers the salad and the sandwich. We don't give free lunches.
It's only an hour, right? 1 hour deal on the 20th?
Well, we ask that they get there like 11:30 or so, just so there's plenty of time for Q&A and stuff. But, her talk is just a little under an hour.
Plus, they get to see your picture up on the wall there when they come in, correct?
I don't know. Do I have a picture on the wall?
I'm kidding. We took it down. We put it up while you were in town. We took it back down when you left. So
I'm all for taking my picture down.
As long as it's taken, you're okay.
Remember, 24 hours a day, 7 days a week, you can call us at 855-935-TALK, and we'll answer your questions on our podcast. And please check out our podcast at your favorite podcast service, particularly Apple Podcast. You can subscribe there. That'd be nice. Thanks.
Tom and Don are talking real money.
Would you like to talk to a real investment advisor for free? Set up an appointment at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Now, once again, women do face some special financial needs and situations. That's why we've created a new class. Barbara Devereaux with Vestry's created a new class called Female Financial Fundamentals. It will sell out. It's on Wednesday the 20th. It's a lunch ed. So get your tickets now at TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.